Hi, I'm Mike Resnick, an associate in the tax department at Sutherland, and today I'm joined by a partner in the tax department, Ellen McElroy. And recently, there's been a great increase in the amount of deals that have occurred, and with these deals, there are a host of expenses that taxpayers should consider whether they have to capitalize or deduct.
That's right, Mike. One of the first questions that comes up when a deal is completed is, what do I do with all these transaction costs and how many of them can be deducted? It's important to note that the general rule for transaction cost is that they're non-deductible. That is, amounts paid in the process of investigating or otherwise pursuing a corporate transaction are non-deductible. The range of transactions that fall within this rule is quite broad and include general corporate acquisitions, the issuance of debt, and the issuance of stock. Nonetheless, opportunities remain to deduct a portion of costs that are incurred in a corporate transaction. These costs range from costs associated with general advice, with integration, and with abandonment loss. The single greatest exception, I think, for deduction has to do with investigatory due diligence cost.
You're exactly right, Ellen. And in the regulations, this exception provides that investigatory costs may be deducted for certain acquisitive transactions, referred to as covered transactions in the regulations, when these costs are incurred prior to the final decision to proceed with the corporate transaction. This date is commonly referred to as the bright line date. Now, in addition to this bright line date, the regulations also provide for success-based fees to be deducted, provided that there is documentation to support the deduction. And after about 4 or 5 years of exam activity, the service came out with the Revenue Procedure 2011-29, which creates a safe harbor with how to deal with success-based fees. And what the Revenue Procedure does is state that if 30% of the success-based fee for a transaction is capitalized, the remaining 70% can be deducted, and there is a subsequent LB&I directive that instructed agents not to challenge application of the safe harbor by taxpayers.
Mike, in our practice, we spend a lot of time in controversy and helping companies that have incurred transaction costs and which may be challenged by the service in an IRS examination. A couple of the questions that we've seen recently are shown on the slide. One of the questions that we frequently see in exam is whether a particular transaction is covered. That can arise when you have a transaction that is both taxable and non-taxable, because the exceptions for covered transactions include taxable acquisitions of a trade or business and a taxable acquisition of an ownership interest in a business. If you have a transaction that includes both taxable and non-taxable aspects, how do you treat it? We also see regularly raised whether particular transactions qualify as success-based. This has become even more important with the addition of 2011-29 because so many companies want to fit into that revenue procedure, and it is limited in its scope.
I know additionally we've talked about and seen with exam whether milestone payments should be considered a part of success-based fees or treated separately, and that's also been a very common issue considering how common milestone payments are in contracts today.
And one of the most significant things we've seen recently is issues that arise in a private equity context. One of the most common questions that we see is which expenses are properly taken into account by the portfolio company. Generally, in a private equity transaction, you have different parties that arrange for particular transactions, but the services may in fact be rendered to the portfolio company. When are those expenses properly taken into account by the portfolio company? This could also arise in a consolidated transaction where you have a parent subsidiary or with a foreign U.S. entity. So we have just begun to scratch the surface of issues that arise with transaction costs, but hopefully this has been helpful as companies begin to think about how to treat transaction cost.
If you have any further questions, please feel free to contact either of us and visit Sutherland.com for more bottom line videos.